Hey folks, Dan Frio here, the Mortgage Update. Today is August 31st, 2020. Why do I do that? Oh, great idea. Great question. I do videos every day, as you know, but a lot of times when people would watch the video, they're like, what day did you do this? So I start out every video with a date and time and kind of stuff like that. So you kind of at least know what day I'm working on or talking about. So that being said, great day for rates, because the Federal Reserve, one of the top people there, came out with a comment and it helped the market bring us back to where the lowest rates in 3 weeks. So don't go away. That's what we're going to talk about next. See you then. Well, the headlines for today is lowest mortgage rates in 3 weeks. Well, this kind of threw me for a loop because I'm thinking, if you follow my channel as well, the assumption is mortgage rates are pretty much going to be stable. We might have a little bit of an easement or a slight jump in rates. I wasn't anticipating the move that we had today, and I'm going to explain why. And then there's another factor in regards to stocks that I'm going to go over here shortly as well, that is very bullish when it comes to bonds. So let's get on to it. People follow my channel because of this number right here. This is what we call mortgage-backed security. This is a bond that trades, that basically this is the biggest component of what creates mortgage rates. Okay, it's this plus profit margins and other things, but this is it. In a nutshell, I'm just going to make this in its bare bones, simplest forms. Green is good. That means rates are coming down. Prices of bonds are going up, rates are coming down. Red is bad because it's the price of the bond is going down, yields are going up. All right, so that's what's happening here. Well, last week the Fed announced that they're going to change their policy. Their two biggest mandates that why they're in existence is two big mandates. One is employment and one is inflation. So they try to keep inflation intact and the economy at full employment. Well, last week they came back and said, well, the inflation thing, the triggers that we have in place, we're actually going to change our policy a little bit and say, instead of capping out, we want inflation at 2% and basically right there, we're going to let it run a little hot. And it can go up to 3, 4, 6%. And our main concern is basically going to be employment. We want full employment. Well, that spooked the market because inflation is the reason behind, in its simplest form. Talk to mom or dad or grandma or grandpa, and they used to get a hamburger at McDonald's for 25 cents. Now it's $4. That's inflation. Basically, in a nutshell, inflation is what causes prices to rise and or fall in a roundabout way. Let's leave it at that. So when they came back and said, inflation, we'll let it run a little hot, it scared the market, especially the bond market, because you invest today to get a return. So let's say I invest my money and I want a return of 5%. Well, if inflation's at 1%, that's how much the dollar is going to devalue over a year. So I'm getting a 5% return, and inflation is at 1%. That basically means that my true rate of return is 4%. So it's my 5% gain minus my 1% inflation index. Okay, so I get a 4% rate of return. Well, if inflation goes to 2, 3, 4, 5, 6%, and I'm still getting that 5% yield 10 years from now, I'm basically in the negative. I'm getting a 5% return. Inflation's at 6. I'm basically losing 1% on my money every year. That is why last week's Fed comments spooked the market, because they're saying, we're going to let it run hot. We're going to make it average 2% over, and they didn't really specify time. So if we're running at 0.9 right now, round it up, we're running at 1 right now, that means inflation can go to 3% and we're still averaging the 2. So that spooked the market. big time last week, and a lot of people started dumping bonds. Mortgage-backed securities is one of them. So right in this time frame here, we saw a big sell-off in bonds. So again, when the red makes rates go up. So people were saying, I want a higher yield on my money. So that's what happened right there and then. So today what happened is the Fed came out, actually the second person, highest person at the Fed, they came out and said, we're going to, here I'll actually give you the comments right here, and I'll try to zoom in as close as I can right in this here. Fed Vice Chair came out and said that he believes the yield curve control should be an option. So what that means is basically the Fed's going to come in and say, we want mortgage rates or we want MBSs to stay stagnant here. So this is yield curves, all right? So what we're going to do is we're going to come in and buy up as much as we can to keep it stable and or not buy as much depending on supply and demand. So they're going to kind of, hate to say it this way, kind of manipulate this market to keep rates low as long as they possibly can, thus to drive up the employment numbers. Fantastic news. Everybody loved it, and you saw basically a recovery back on the bond markets. So that's why the headlines read, lowest mortgage rates in 3 weeks, because we've recovered a lot of this, the fears in the market. So that's what's going on there. The stock market really didn't like it, and it sold off. Okay, here's some great news on what I feel for the bond market, especially mortgage-backed securities, but not so good news for investments, meaning stocks. And I've been saying this for the past couple weeks now, saying I think my personal feelings on everything I follow is that stocks are highly overpriced, and we're going to have a correction. And it could happen tomorrow. It could be 2-3 months from now. And I hate the one people that come out and say, yeah, we're going to have a correction. It could happen in the next 20 years. Well, no crap. We're going to have a correction in the next 20 years, no matter what. In housing, in the stock market, in the bond market, in the car market, in the student loan market, in every market, you're going to have a pullback to neutral. So one of the numbers that Citibank does a fantastic job on it, they actually have a greed or a euphoria index. Well, this is one that I don't know where CNN Business picked this up, but this is an index kind of created by Citibank, and it's saying right now we are in an extremely greedy period for the stock market. When we usually hit that, we'll have a pullback. That means everything is overbought, meaning the stocks are too high. Everybody and their mother are just piling into stocks. We are going to have a pullback. This is just going to determine how big that pullback is going to be, because it could get kind of scary. What's happening right now is the Federal Reserve, like I said, even with the bond markets, they're pumping monies into every sector of the business. They're pumping it into bonds, mortgage-backed securities, corporate bonds, freeing up money for a lot of individuals, the stimulus packages. Actually, the stimulus package, if you follow my channel on a daily basis, $800 billion in salaries and wages was lost during the COVID downturn. 2.1 trillion was paid out in stimulus to those that lost their jobs. So almost three times the amount that most people would earn is what was getting paid out. Now you might say, Dan, that's crap, because I make $100,000 a year and I'm out of a job and I'm getting $600 a week in your situation. But overall, $800 billion in wages were lost. 2.1 trillion was paid out by the government as stimulus. That's a lot of stimulus money. So they're pumping money out into the markets. People are investing in stocks and bonds and every which way to invest anywhere and anything they can. Even the housing market is running rampant. So are we having, like last week I did do a show quickly on what's happening with the housing market. And let's see if I have this new Fed. Here's the thing captioned right on the beginning of CNBC. The new policy is a big benefit, though, for us right now. So it was great news in the markets, but the housing market numbers are just tearing it up. Let me see if I have anything in here in regards to that. I don't think I do, unless you're looking to buy a house. So I did a video last week, and I kind of went through it and said, the housing bubble of 2020, that's the big clickbait right now. Everybody's saying, the housing bubble, is it going to crash and whatever. I don't really think so. I think the Fed is going to do everything they have to do to make mortgage rates as low as they can. The people that are in trouble with their mortgages, the Fannie Mae and Freddie Mac, and a lot of other agencies, especially the government, is doing stimulus package to either allow people to go in forbearance, skip payments. They're giving extended unemployment. They're doing everything they can there. The banks learned back in 2007 through 10 that we really don't want to foreclose on anybody because that only crashes the whole market. So I think the banks are going to start working with homeowners and put them into modifications in different areas there. And I'll talk about that tomorrow when we do the rate comparisons on what refinance rates look like, why you should probably refinance instead of modifying your loan. That's a whole different story. So is there going to be a pullback in value? Yes. Is it going to be as catastrophic as it was in 2008 to 10? No, because those were just bad loans, period. Bad underwriting. And consumers and everybody got wowed into it. Bankers were making more money than they ever made in their lives. People were getting into $500,000, $600,000, $700,000 homes that were making $30,000, $40,000 a year. That the math just doesn't add up, unfortunately. So there was just bad loans out there, and when it crashed, it crashed. So is there going to be a pullback in value? Yes. Is it going to be as bad as it was? I don't think so. And because everything is pointing to the direction as we learned our lessons. So basically, economic calendar for the week. Construction spending and manufacturing numbers are coming out, ADP payroll. Unless basically what we see here is basically through this week is employment or unemployment. I don't think things are really going to shock the markets there to really affect mortgage rates. Because as we said right here, the Fed is jumping in, doing everything and anything they need to do to control these markets and keep rates as low as they can. That is backed up by Vice Chair Richard Clarendon, who also said it there. And you can find that even on, headline news. New Fed strategy means cheaper loans for a long time. That's where we are today. I hope you like my videos. If you do, oh, shoot. You were watching me instead of my monitor. Let's go through it one more time. Federal Chair Clarita came in and said, we're going to basically control the bond markets to make rates as low as they can be for as long as they can be. Those headlines are also captured on CNBC News there. So I apologize. I was rambling and skipping all around, but I hope you like what you see. If I could be of any help to you, you want to reach out and say, Dan, what's going on with what can I get for a rate? I'm looking to get pre-approved. Anyone, refinance, pre-approvals, anything you need to do, please go to the rateupdate.com. You can click down here to get pre-approved for a home. Click right here to see what kind of rates we can get you. If you want to reach me personally, just call 844-775-LOAN. That's 844-775-5626. My name is Dan Frio. You can reach me at D for Dan Frio, which is Frio, at preferredrate.com. And I'm trying to hit 10,000 subscribers. And we tore it up over the weekend. Thank God to you guys. So I think we're like 200 short right now. So please, if you like the video, give me a thumbs up. Don't forget to subscribe down below. Hit the bell. So every time I do post a video, you can see at least what the video is about. If you want to watch it, great. If you don't, skip it. Here's what I ask people to do. Today was kind of a slow day for some reason. I don't know if the kids are getting back to school and everybody's inundated with that. But what I ask you to do is if you're in the process of buying a house or refinancing, you already have a quote, send me the quote. And I'll get back with you probably within an hour saying, here's what you got. Here's what I can do. I'll write all through it in red numbers. Today, a lot of the quotes I got were about 3 to 3.25 was the rate with about $2,000 average in fees. I averaged back about 2.875 in rates and about $895 in fees. So that was the ones I responded back on today. But again, if you got pre-approved or you're looking for a refi, send me a copy of what's called your loan estimate or your fee sheet that you have from the current lender, and just email it to me. The one missing item that I don't know, so the pieces of the puzzle that I need to know to give you a quote back, is the value of the home, the loan amount, and your credit score. Okay? If you know your credit score, just give it to me. Let me know, and most people do this. If you don't, one of the sponsors of my show is the Credit Scores and More. So Credit Scores, plural, and more.com. Go there. Step 1 is it gives you a free credit score. So if you don't know your credit score, just go there, click that. It'll take you 2-3 minutes. Send me what that score gives you. And I'll get back with you within an hour. 99% of the time, I'm beating every quote out there. If not, I'll say, you know what, God bless you. Take it, sign it, what you got with the other lender, lock it in, and run with it, and you're good to go. So that's all I ask for you to do. So hopefully you like my video. You reach out to us for some assistance. Other than that, God bless. Take care. Be safe. See you tomorrow. Same time, same place. Bye-bye.